Welcome back. In the previous step, we explained what investing is. Now, we're going to talk to you about the stock market. You've probably heard of the stock market before, but do you actually understand what it is and how it works? For most of us, it just kind of shows up in our lives one day, and we're expected to know what it is. But many of us don't really get it because we've never been taught. Even if you're one of the lucky ones who do get it, we think you should stick around anyway. You might learn something new. In simple terms, the stock market is a marketplace where people meet to buy and sell securities or financial instruments such as stocks. As you'll recall from the previous step, stocks represent a small piece of ownership in companies. We're going to take you on a quick history lesson. The first stock market dates back to Amsterdam in 1602, when money was needed to finance expeditions to East Asia to explore new lands. The Dutch East India Company was created, but the owners didn't have enough money to pay for their expeditions on their own. Since they knew other people would be interested in helping out, they turned to the general public to raise money for the journey. The Amsterdam Stock Exchange was created to sell little pieces of the Dutch East India Company, which they called shares, in exchange for a part of any future profits that the expedition generated. With this, the Dutch East India Company became the world's first publicly traded company and no longer had just one owner. Everyone who bought a share or stock, which are now referred to interchangeably, was now a part owner. Today, there are many more stock exchanges, and any company that sells a piece of itself on a stock exchange is considered a publicly traded company. Today, many countries have one or more of their own stock exchanges. And with the internet, it's no longer required to go to a physical location to buy and sell shares. The stock market has become an electronic platform where you can buy and sell financial securities that represent ownership in something else, such as companies, much like the original Dutch East India Company. The largest and most popular stock exchange in the world is the New York Stock Exchange, or NYSE, which is worth about $28 trillion. Other popular ones that you may have heard of are the NASDAQ, or London Stock Exchange. Today, since everything is online, it matters very little to the average investor which stock exchange they're buying from, especially between two that operate in your home country, because you don't have to worry about different currencies and exchange rates. The stock market has evolved significantly from the early days of buying and selling stocks in one single company. And today, you can buy an ownership stake in a single company. You can buy a group of companies called funds or ETFs, which we'll explain later. You can also buy things like real estate investment trusts, oil and gas, and a lot of complicated financial instruments such as options and futures, which you may have heard before. Options and futures can get pretty confusing, so we're not going to cover them here and strongly recommend you leave those for the professionals. Today, on the New York Stock Exchange, there are almost 3,000 companies and over 1 billion shares that switch hands every single day. And that's just one stock exchange. There are large and small companies, some you've heard of and a lot you haven't. The process of being listed on a stock exchange is pretty expensive and leaves companies with a lot of rules to follow and shareholders to answer to. So the clothing boutique around the corner probably won't be available to buy and sell on the stock market, but your smartphone manufacturer likely is. It's up to companies to decide whether or not they want to sell their shares publicly. But once they do, it can be really expensive to go backwards. Since there are so many companies, people have developed ways to track just the ones they care about, called an index. We'll go into more detail on this when we cover funds, but for now, we just want to introduce you to the S&P 500 index, which is one of the biggest and what a lot of people mean when they talk about the market. The S&P 500 combines the 500 largest public companies in the United States and tracks their performance as a group. This is intended to represent the United States economy. Since its creation in the 1920s, the average return of these 500 companies together has been about 10% per year. This is really important, so remember that average return of about 10% per year. We'll come back to it and repeat it often. The key takeaway from this step is that at its most basic level, the stock market allows individuals like you and me to own a very small piece of very large companies. This is often forgotten and waved away as just a concept that feels so far away. But it's really important to remember, since what happens to those companies will directly impact what happens to your money. In the next step, we'll talk about how the stock market and the economy impact each other.